All right, so I'd like to welcome on our stage our final speaker of the day, Lewis Christopher, founder of SQM Research.
Good afternoon. Nice to be with you. Good to see some familiar faces out there. We're going to cover property, of course, and property I could speak all day on, so we're just going to focus a little bit on the A-REIT market, actually quite a lot on the A-REIT market, and a little bit on what's going on with the office market as well, overall. Now, I don't normally like to point out disclaimers, but today I will, because we're going to get down to some individual real estate investment trusts. That information I've put together could be wrong. My judgments on that information could be wrong. And believe me, some of these balance sheets that I've been going through are certainly open to interpretation. So just keep that in mind, please. A reminder, in October 2008, the ASX S&P A-REIT 200 index collapsed by 75% from peak to trough. It was the largest crash in Australian listed property trust history and one of the largest crashes at the time for 2008 worldwide. The correction was larger than the global REITs. Some of the well-known names such as Centro and Valad completely disappeared. At one point in time, essentially funds management businesses within these trusts were valued at nearly zero. Now, eventually there was a recovery, but the truth was that many investors who tried to pick up on that recovery were diluted to the nines. And the reason why was that the banks were forcing many of these REITs to raise capital to survive. And so in terms of a real recovery, it really actually wasn't that much for investors to begin with. Let's talk about offices. What I got here is the office rental vacancy rate index supplied by the Property Council of Australia. And you'll see it's split between CBD and non-CBD. As you can see, the trend is up. In fact, we're almost getting to the point of where we were in the 1990s recession. I thought this time last year it might peak. I was expecting a resurgence in the return to work, to the office, shall I say. And that has happened, but it's actually been slowing down of late. We've reached peak quite quickly. But at the moment, the trend is definitely up. And I would like to also point out that I'm seeing anecdotally some really heavy discounting occurring out there with the offices. So my office now, SQM Research, it's over in North Sydney. There is a blue chip property recently constructed over there, 88 Walker Street, if you know it. I think it's owned by Charter Hall. I can tell you now, in that prime building, they're offering incentives at 37%. That's where it's at the moment, prime at 37%. The average, I think, is running at just over 30, but that's what's happening over in North Sydney from what we can see firsthand. Oops. Okay. Now, this data has come from Cardigal. They're a real estate agent, so make of that what you will. It shows what's been going on with rents. I take the view that it's likely that in 24 we're going to see a fall in rents officially. I think it's happening as we speak. And as mentioned before, we're seeing some very strong incentives now. The office REITs in particular have got some issues going on. They're going through a period where capitalisation rates are rising upon them. Costs have been rising faster than rents as well. So the net income that's been coming through to investors hasn't been that crash hot. But just focusing on the overall market itself, I do remain rather bearish on the outlook for office. You'll see that circled line there. That represents what is coming onto the market this year. Last year, there wasn't actually a lot that came on. A fair bit of it was mooted. But there's a lot coming on this year. And here we are with vacancy rates in the teens. So hence the reason why I'm not feeling particularly confident about this sector, or perhaps it's fair to say I don't think it's the right time to buy in quite yet. Now let's talk a little bit about the REITs. This is a chart I personally put together. It goes back for some time, and it's looking at basically prices versus net tangible asset backing. Because when you're buying a REIT, what you're buying is the underlying property, or that's what you hope you're buying, right? And so I found this to be a pretty good predictor and a pretty good measure of where fair value is. And at the moment, on an unweighted basis of the index, you basically would be buying into the AREIT market at about $1.11 to $1 of NTA. Now, I'm about to show you something which you'll see some quite divergence between those pricings. The long-term average for this space is about $1.03. The high was $1.73 in 2006, and the low was 35 cents in the dollar in 2008. It was quite the correction. I'm sure many of you around here will remember it. Now, if you actually bought the index today on the index itself, the actual very index, based on the weighted market caps, you would actually be paying near 2 times NTA. And we'll go into that very shortly as to why. Now, feel free to take photos. There's a lot of information here. What I've done here is looked at each of the individual constituents, and I've ranked this, as you can see on the bold column there, on their price to NTA. Now, what you're going to see here is for a number of the offices, they rank right up there. They are being discounted by the market. Okay, but when you look at the consensus dividend outlook, for many of these, it's negative. And I happen to agree with the brokers on this. It is negative. One thing I've also noticed since I last actually put this together is that betas have been rising. They've been rising for most of these REITs. You see some good dividend yields, but be careful of the value traps, because the outlook for dividends for a number of these is indeed negative. Then I want to point out to the very bottom one, Goodman Group. Look at the price to NTA at the moment, 349%. Okay, when you buy into Goodman Group, and keep in mind this is 37% of the index, you're buying a fair bit into a funds management business itself. This is the reason why it's priced so high. And everyone loves industrial at the moment. I don't know why, it's not that sexy. But it's certainly been bidded up, that sector and this particular stock. And it's one of the things I got to just say up front that when it comes to this index, I'm not a great fan of the index. It's highly concentrated, and you see these things occur in the market. Let's move on. Here's the actual breakup so you can actually see the composition of the AREIT 200 index. The top 3 stocks, Goodman Group, Stockland, Scentre Group, 55.5% of the AREIT index. It's quite a lot, quite a lot. Now, this index has always had high concentrations, but I would put to you that you should question that. You should question when if you just want to have a neutral exposure to this index, this is what you're really buying. All right, let's have a look at a breakup here. What I've done here is, for the next few slides, I've looked at basically the average unweighted or equal weighting of each of the constituents versus the market weighting. So the first chart there, or the first pie chart on the left there, represents what are you actually buying into. Are you buying into a funds management business when you buy an index, or you're buying directly into property? And that's the breakup. About 72% towards actual property and 28% towards a funds management business. Unweighted, the numbers are a bit better in favour towards property. And the reason is going back to Goodman Group. Goodman, of course, the single largest stock in the index. He's heavily weighted towards a funds management business. Okay, let's have a look at the breakup of the REIT index by the sectors, office, industrial, retail, housing, and so forth. On the left there, okay, is the actual index. If you're buying the index, these are the sectors you're actually buying into. And as you can see, it's heavily weighted towards industrial. It's a little bit sort of light on office. Maybe that's not such a bad thing right now.
and it's got a fairly good weighting towards retail. If you decided just to go equal weights on the right there, that's what you would end up actually holding. You would see a higher weighting towards office right now and a reduced weighting towards industrial. The others are broadly the same, a little bit more on retail, I guess. All right, once again, a lot of data here. So what I've done here is try to do a look through on each of these individual stocks so you can see what you're actually buying if you decide to go down the individual pathway of stocks there. And firstly, the blue lines there on the left there, that gives you the breakup between funds manager and property owner. The next black columns there, the split of the office space there, and then on the right there, how much are you buying in terms of, are you buying into a developer or are you buying into established property? Overall for the index, the exposure towards development isn't actually that high in the scheme of things. And it generally happens through Stockland and through Mirvac. Okay, so I mentioned before price to NTA, something that we should always follow closely when you're looking into this space. You can see there at the moment, unweighted, you'd be buying at $1.10. We've seen some examples there where you can buy very cheaply, but has the market price in all the negativity? That's a good question. And then if you actually just bought the index as it is, you'd be paying a lot more because of what's going on with Goodman Group. This is the gearing. It's a bit of a flip side there actually. And that is because if we went back to that original chart, you'll see a number of these REITs which are discounted heavily actually have a fair bit of gearing going on right now. The gearing levels have been rising. Now they're not, I stress, they're not at the levels we saw in 2008. Probably about 10 percentage points off. Basis points, that is, sorry. But they've been creeping up. This is the beta. So on the left there, unweighted versus weighted, we're getting a beta of running about 0.9. That's been creeping up. And then the distribution yield, definitely higher if you were to go unweighted, the index, versus weighted. So Goodman, for example, is trading on a dividend yield of just 1% right now. Okay, one of my favourite charts is the cumulative excess returns chart. So what's going on the left there is basically I've run, and this is off our Fund Explorer subscription, I've run a blended unweighted portfolio or equal weighted portfolio versus the index itself. And you can see there, if you just went equal weight on these stocks, you'd be well ahead since 2008. Now, sorry, that's just essentially taken from the bottom of the market. That's as far as the data went. In more recent times, going the weighted index or the index as it is, you would actually be doing a bit better because of the rise of Goodman. Goodman price has essentially doubled in the last 18 months. You'll see I've got a correlation to the asset classes that's based on an unweighted basis. Notice the difference in correlations between the last few years and back to since March 2009. Quite interesting because the REIT market has been more positively correlated. And then as shown more recently, you can see the splits between a blended fund, which would be completely unweighted, versus buying the index itself. Last, basically, 23, you were doing better with the index, and so far this year you are doing better with the index. But prior to that, you were doing better just going underweight those mega stocks. So, overall conclusions. Office REITs are significantly discounted compared to NTA, but we're not quite there yet in terms of the underlying market trough. Watch out for dilutive equity raises. Now, I don't think we're going to see equity raises right now, but if we were to see a recovery, I think you would then see a number of these managers come into the market and raise more equity to try and get acquisitions. When strictly looking at the index itself, it's currently trading nearly 2 times NTA. That is because of the significant premium to the top 3 REITs are trading at, especially Goodman Group. The index has high concentrations towards industrial and retail, but at a reduced weighting towards office compared to an even weighting of the constituents. And finally, a note here, of course, it is highly concentrated. That makes for some significant risks. So when you're thinking you're just buying passively into this index, I would say given the concentrations, you've got to be careful. I think that's it. It is. Thank you.
We do have a couple of minutes. Is any questions from the floor? Yeah. 1 second, we'll get you a mic. 1 second.
Just a quick question on thanks. A general comment on the veracity of across the board NTA published NTA values for a lot of and do you think they've really been tested in terms of asset sales?
No, is the answer. Okay, so we've seen the valuers just creep up the cap rates, and they do this every cycle. And look, I can understand why they do that. They wish to be conservative. They don't want to jolt the market. But it's pretty clear to me when I've looked at, say, for example, the risk-free rate, the 10-year bond yield, versus the cap rates, okay, there's still quite a gap there. And so I believe there'll be yet another round we'll see in June, where we'll probably see another 20 to 30 basis points. I know there are some fund managers out there who think we're at the top, but if I'm right that the outlook for distributions on office, if I'm right about that, cap rates will need to keep going up because the risk premium will need to rise, given a negative outlook in rent. So just keep that in mind.
Louis, hi.
Nigel.
Are there any pockets of leverage there in some of these REITs that we would need to be concerned about if those cap rates do correct, sort of along the lines you're saying?
Did you see that chart I had up there with all the individual gearings?
Well, I couldn't take all of them.
Yeah, sorry, I know. There was there was a lot there, wasn't there? Let's even go back. All right, this should answer your question. So, okay, where is my gearing? There it is. Okay, after the bold lines there. So the top there.
All right. Okay, there it is.
You can see the gearings there, right? So that's look through. They're higher than where they were 5 years ago, not as high as 2008, in my opinion. But, you know, let's think about this, right? Let's say you're sitting on 50% gearing. Okay, a good chunk of that you're paying interest expense. And at the same time, your property costs are rising faster than your rents. It's not a great spot. So I'm just a bit concerned that, yes, as you can see here, there's some good discounting going on to NTA, but certainly with the offices, we're expecting the NTA to come back more, and potentially with some of the other sectors as well. Okay, their costs will rise, so the distribution is likely to fall. And that's even before we look at the rental outlook, which is looking pretty negative. So yeah, as you know, leverage is a killer. Well, it can be anyway. I'll leave it on there because it's interesting. Take some shots there. Like I said, I could have got some of these numbers wrong, but you know, going through the balance sheets has certainly been fun.
Over there.
Yeah, just probably the final question. There's obviously a deep correlation between interest rates and the gearing, and obviously we explained that.
Yeah.
So as a side point, and I mean everybody probably asks you this, and you're in the Fin Review every second day, but what's your outlook for interest rates for the rest of this year, calendar 24? Because there's...
You're speaking of the cash rate?
I'm speaking of the RBA cash rate, yes. Which impacts on what we've just you've presented.
Okay, well, look, just my opinion, I don't think we'll see a rate cut soon. Maybe second half of the year. We need to think about the CPI basket itself and what's driving that CPI basket. And one factor which I look at very closely, of course, is residential rents. That's the single largest contributor to the CPI basket. The ABS has been a bit dovish on rents, put it this way. They reckon rents over the last 12 months have gone up by 7.5%, but I know market rents have gone up by 13%. And indeed, over the last 3 years, they're up by about 35%. That's going to feed through into their series on rents sooner or later. It has been feeding through, but it will go up. And so that's going to probably keep the CPI somewhat elevated, in my opinion. So, of course, there's many factors that could happen out there. We could go into recession. Then they probably would cut. Sure. But I just don't believe we're going to get that rate cut prior to mid-year, put it that way. But that's just my view. Yes, they have, but they've been rolling off. And that's a critical, if you want to look at some of these individual stocks, get into their balance sheet and read the notes, and it'll tell you when their hedging's rolling off. So a number of these REITs, they've got some great deals with their hedging. You know, they locked in at the right time, locking in essentially lending rates at around circa 3%, but it's rolling off. Yeah.
I'm an asset allocator, and so for me, when I look at the commercial space or REITs in general, I definitely see there's troubles here. But for me, I'm looking next what's happening tomorrow. In your mind, what are the milestones that we should be looking for in terms of after the supply surge, after cap rates? What are those milestones that we should be looking for before we as investors can get back into the space with comfort?
Well, I think over the next couple of years we'll have better information in terms of where the working from home arrangement finally settles at, and that's going to be critical. We don't know, it's still moving. I'm aware of businesses where they are demanding their staff to come back to work 5 days a week.
Yep.
Others are still at 2 days a week. Some big institutions are just at 2 days a week. So we'll see what happens there. I think this will be a critical factor.
That's a good point.
Then we need to consider, well, where are we in the cycle? Are we going to have a recession? Now, if we go into recession, okay, the last big recession we had back in the early 1990s, offices were smashed, absolutely smashed, okay? And industrial was smashed at that time as well. So that's definitely a factor, and I don't know if we're going to go into recession. The government's trying everything they can to stop it, including making sure immigration keeps running hot. You know, it's certainly a possibility.
All right. I think that is it for questions. Thank you very much.
You're welcome.